Jim, I'll just start with you, and please help us make heads. Is this a once-in-a-lifetime chance to buy higher yields or no?
Well, I think yields are going up because the market is not completely convinced that inflation is behind us. Now, it's not worried about 8-10% or Zimbabwe inflation, but it is worried that we might be in a 3 or 4% inflation world. And if we are, then you could be looking at bond yields that will be settling in closer to 5% than to 4%. And that's what you're seeing with the 10-year yield and with the 30-year yield. They're starting to drift towards that target. And ironically, it might be because the Fed has backed off of tightening that the bond market is starting to get nervous. If the Fed's not going to fight the inflation fight, then it's going to fight the inflation fight by selling off bonds. So I think that that's the big picture. That's what's been driving bonds for most of the last several months as they've been moving higher.
Ron, I sense you don't agree here.
Not entirely. I don't disagree fully. I also think that the bond market has not ruled out the possibility the economy will avoid recession completely and maybe accelerate rather than decelerate, whether or not inflation goes back up. You look at the Atlanta Fed GDP nowcast, 5.8%.
But they've been high forever.
They've been high. And look, they could be 2 or 3% high at 5.8%. You're still coming at, 3.8%. Annualized rates of growth in third quarter. No one expected that. Everybody was looking, myself included, a couple of weeks ago for sub 1%. That's not happening.
But let me get back to Jim's point here, and that is that maybe the inflation fight isn't done, and that we're not going back to a 2% inflation rate. We're going to a 3 or a 4% inflation. Doesn't that suggest that the Fed will have to do more? Will have to raise longer, raise more, keep them higher longer? Something I think you've said they don't need to do necessarily.
Yeah, I think if it's a 3% inflation world, they don't have to do more because you have 200 basis points, 250 basis points of real interest rate built into that, which is a relatively restrictive policy. And if we, it's interesting, Tyler, if we go back, a decade, right, where we spent 12 years trying to get inflation above 2%, and then the Fed started talking about average inflation rates. If we were at 3% for some period of time, if you X out the pandemic and the immediate response thereafter, you'd kind of be where the Fed wanted to be in the first place, which is having an average inflation rate where it's been historically at about 2.5%. So I think there's more growth being built in, less recession being built in. Inflation, I'm not sure about. I still think, with the exception of a couple numbers in the next couple months, it may be sticky. It's still coming down.
Jim, I guess we have to talk about, on the short end side of things, it's really just about what the Fed does with rates, how long they leave them high, when they start cutting. You think Jackson Hole will shed some light on that?
Well, it should. That's kind of the big speech of the year where Chairman Powell or whoever the Fed chairman is kind of gives their long-term outlook. Remember, a year ago was that famous 8-minute speech where it's been dubbed the will be pain speech, and subsequently there was never any pain, and unemployment rate came down and stock prices went up. But I do want to come back to something that Ron said. I agree that a part of the equation here is that the economy is doing very well. And you're seeing that on Wall Street. They're all throwing in the towel on their soft landing and recession forecasts, and they're upping their forecasts. But that could be fostering, too, to an excess demand or extra demand that is pushing in prices higher, which is inflation. And so the market, I think, is getting more and more worried that we're going to be in, if you add real growth plus inflation, a high nominal world. And that's what these interest rates are reflecting. Furthermore, if you just take a look at 5% or 4 or 5% interest rates, if the economy is accelerating, it's a big sign that these rates are not restrictive. We could go through models and say, hey, look, they should be restrictive. It's 200 basis points above this or that. It's not, because the economy is accelerating, and it's telling us in real time that it's not hurting.